Well, hello and welcome to everyone here on YouTube. Thank you so much for joining me. So, what I want to do here is really show you guys a very powerful way of utilizing options when you're just buying an option, right? So, if you're just buying an option by itself, there are some things that you have to know. Now, I was speaking to you all not that long ago, saying that once we start to, once I get home from traveling, I'm going to start looking at showing you guys some more education here. You guys were very big on that, and you can see that the new name of our channel is Think Smart Education. Sort of does describe more as to what we do. We're bringing in some new content, really teaching you guys some stuff here, and I think you'll get a lot of very valuable information from this, right? Being able to understand strategies, the thinking behind it, and that sort of thing. So if you haven't subscribed, please go ahead and do that. We're really going to ramp up this channel and show you guys some really cutting edge strategies that can help you enormously making money in the markets. So let's talk about the overall market first, and then we'll actually teach you something when you're going to be buying an option, right? Really give you some education here. So right now, the opening range is 3971.73. This is 92% accurate. Why are we choosing these two numbers? 3971 on the upside, 3939 on the downside. So if it's above 3971, we're bullish opening range mode, which quite obviously we are right now. And if we're below 3939, we're in bearish opening range mode. It's the first trading day of the month. And then the high and the low, right? That's what those two numbers represent. And then obviously on the third Friday of the month, options monthly expiry, we set the high and the low of that day. They operate as the opening range for the entire stock market, 92% accurate. So I love this, and that's the new opening range for now until the third Friday in March, which is the 17th of March. Okay, so we're in bullish opening range mode. But I spoke to you last week, and I said, look, the 200-day moving average is right here. I think we're going to bounce off this and move higher. I also said the combined put call ratio, when we look at the 10-day moving average, is over 1, as it is still now. When that happens, it shows there's too many people that have been selling. Too many people are hedged or short. This is an insanity point, and we would expect to see the markets move higher from here, right? So you type in $CPC, stockcharts.com, then you go down and change this parameter to 10-day simple moving average. That metric there, the 10-day simple moving average, is what you're looking at. Above 1 is bullish, right? There's no one left to sell. Right? People are jumping on the buy side, which is exactly what we saw this week, right? So I talked about the fact that we were bouncing off the 200, the combined put call ratio, 10-day moving average being above 1, and I'm looking for us to move higher. That's exactly what happened. So that call was absolutely spot on from last week. Now, we've had a lot of real estate or housing data over the last couple of weeks, and we can see right now that mortgage applications have fallen to a 28-year low, right? The stress test to be able to get a loan now is much more difficult, making sure people can really afford it, with a huge increase in the cost of living, the increase in interest rates we've seen, people's real income not keeping up with the rate of inflation and the cost of living. So they're making it much more difficult to get loans, and also people that already have home loans are finding it more and more difficult to make the payments because they keep going up because of the interest rates. So that's not surprising, right? So starting to see a few cracks there in home prices now, or the housing market. What's coming up this week? Well, a lot of employment data, right? We've got Jerome Powell, who's testifying on Monday and Tuesday. Certainly be watching that as well. They've got jobs opening, the JOLTS job opening. We've got unemployment claims. We've got the ADP non-farm payroll on Wednesday, the non-farm payroll employment change on Friday, hourly earnings. So a lot of labor market data and news coming out. They've been able to continue to raise rates because the labor market has been very strong, as we saw with the non-farm payroll last report, very strong. So when the labor market's still strong, they can afford to continue to raise rates. But once that starts to show big signs of weaknesses, that's when they sort of pull back a little bit, because they can crash the whole system. So that's what they're going to be looking at this week. They'll be watching that very closely, no doubt about it. And then we look next week, we've got CPI numbers, inflation coming up. So that'll be a big week. So watching employment this week, inflation next week. So that's what's happening there. But I think right now, as far as the market goes, I think we could possibly, with a combined put call ratio still above 1, and we're now in bullish opening range mode and bouncing higher off the 200, we could possibly move up to this very small gap you can see here at 4089 in the SPX. That's possibly where we're going, before then finding resistance and starting to move lower. Okay, so I still believe we're going to move lower, but maybe a short-term continued move higher for now, up to that level, 4089 on the SPX. So having said that, let's have a look at positions we spoke about last week. Alibaba, right now, I'm going to close this trade. It's only a 4% return, right, in a week, which is not that great for us, but it's still okay, still a positive trade. But what I would say with this one, the reason I'm going to get out, right, as far as teaching you guys, when you're getting the index, sector, and industry the stock belongs to moving up, and the stock doesn't go up with it, that shows relative weakness. So while you would look at this and go, well, it's still very oversold and it's still sitting on that support level, I'm going to close it. Yes, it could still move higher from here, but I'm going to close it because that relative weakness I don't like, right? The fact that we've got the industry, sector, and index all moving up and the stock not going anywhere, not doing anything, particularly on Friday, right? Friday was a strong day. Everything, all the indexes were above 1% except for the transports. So it was a pretty strong day. NASDAQ was up over 2% and Alibaba did nothing. So as a result, I'm going to take a small profit on that and just close the trade out. Now, our natural gas trade, have a look at this one. 80% return in a week. So let's go ahead and have a look at Boyle. Look at that, 15.25% return in a week there. How good is that? That is a thing of beauty. So absolutely love that. Beautiful move up. Moved up $1.04 or over 15% for the day. That has now given us an 80% return for the week. So for me, I'm going to close the trade now. That is a gift from the markets, right? 80% return in a week. And we'll close that one out now and take the profit, right? So the two trades from last week, small winner and a big winner. Now, a potential idea that you could look at now is on Hilton, right? We all know the worldwide hotel chain Hilton, right? Now, what I've seen is a big move up, okay, but then a pullback to a significant support level and now starting to move higher again, okay. If we looked at the stacked moving averages to determine the trend is in an uptrend, we can see that the moving averages are stacked bullishly in an uptrend. 89 on the bottom, 55 exponential moving average, 34, 21, and 8. All Fibonacci numbers, missing out the 13. When they're stacked in that sequence, 8 on top, 89 on the bottom, that's an uptrend. When they come together like this, I like that, and then continue to move up. So you can see they're quite spaced out here. Now they've come back together. We've found the level of support. I think we're going to move higher again. Okay, so that's what I'm looking for with Hilton. Okay, now what I'm going to look to do is buy an option here. It presents a bit of a unique opportunity. So let me just show this to you. What I'm going to do is I'm going to buy the 140 strike call for the 17th of March. It's only 12 days from now. So very rarely would I buy an option where it's expiring in 12 days. Why? Time working against you. But what I'm going to do is use the 1% rule. So what the 1% rule says is I don't want to pay more than 1% of the stock price in time value. See, an option's made up of time value and intrinsic or real value. So in order to work out the intrinsic and time value of this 140 strike call option, which is worth $8, okay, I need to work out what the stock price is, which we can see here, 147.57, and compare that to the strike price of the option, 140. So the difference between 147 and 58 cents and 140 is obviously $7.58. That difference between the stock price and the strike price is called the intrinsic value. Okay, in this case, it equals $7.58. Okay. Now, the actual option is worth $8. So the remaining 42 cents is made up of, obviously, time value. Okay, so that's time value. Okay, put that in the beginning. Time value equals 42, right? So if you add the 42 cents plus the 7.58 would take you to the cost of the option, $8. So I'm spending far less than 1%, because 1% would be about $1.47, wouldn't it? Right? So I'm spending far less than 1% of the stock price when I'm buying this option is made up of time, right? So I make sure the time component of this option value is less than 1% of the stock price. Okay, in this case, it's only 42 cents. Now I put my stop in at $4, so I'm risking $400 on this trade. If it's too much for you, don't take the trade. Right? It's $12 days or less. Right? So expiring on the 17th of March. Now, what would happen at the different prices, Sean? What about if it doesn't move up? What about if it moves up a little bit or moves up more? What would the different prices of the stock mean for the value of the option? Good question. If it stays exactly where it is, we'll still retain all of the intrinsic or real value, the difference between the stock price and the strike price of the option, but we'll lose the time value, 42 cents, if it stays exactly the same price. Okay, so if it doesn't move up at all, stays dead flat, we'll lose 5.25%. If the stock moves up 2.5%, the option will move up 41% in profitability. How good's that? 2.5% move in the stock is a 41% move up in the option. If the stock moves to up 5%, up to 154.96, we'll make 87% return on our option. If it moves up 7.5%, we'll make 133% on our option. And if the stock moves up 10%, we'll make 154%. Okay, so a pretty nice return on our money potentially here. Looking for this to get 2.5% to 5% higher over the next couple of weeks, and looking to lock in a return somewhere around here. Okay, so that's what that would look like. Make sure you're not spending more than the option price is not made up of more than 1% time value. 1% of what? The stock price, right? That's how you know. So even a 1% move up in this stock would see us profitable, right? Just a 1% move. So that's what I'm looking for there. I hope you guys found that useful. So you've got to understand that when you're looking at buying an option, you make sure that you're not paying more than 1% of the stock price in time value. Very, very important. In this case, we're only spending 42 cents, times it by 100, the option multiplier, you're spending $42 on time and $758 on intrinsic or real value. Okay, so make sure the time value is less than 1% of the stock price, and that's how you would do it, right? And then at the various prices or the increases in the stock, which we're expecting the stock to move up, they would be the different profitabilities that we would make on the option. We've also got to stop in at 400, so that would be our worst scenario. We lose 400. All right, my friends, I hope you found that useful. I'll talk to you again next week. All the best, and bye for now.